If you're retired or getting close, you are probably feeling stuck between a rock and a hard place right now. And that rock? The stock market. It's hovering near all time highs. Volatility feels like it's one headline away. And deep down, a correction feels inevitable. The hard place? Traditional safety, things like CDs, bonds, fixed products. Sure, they feel safe. But after inflation and taxes, are you actually moving forward or just slowly losing purchasing power over time?
And here's the real problem. Most financial advice gives you only two doors. Door number one, play it completely safe and accept lower returns. Or door number two, take full market risk and hope for the best.
But Zach, what if there was a third door, a strategy that could give you stock market like growth while helping block the first 10%, 20%, or even up to 30% of a major market drop? Today, we're stepping into the ring with two heavyweights, the reigning champion of safety, the fixed indexed annuity or FIA, and the fastest growing challenger in retirement planning, the registered index linked annuity, or what many now call the RILA. By the end of this episode, you'll know exactly which one belongs in your retirement strategy and why.
All right.
So let's take a look at these contenders here, Zach. Corner number one, the fixed indexed annuity, the FIA. Let's start with the classic FIA. The promise is simple. If the market drops even up to 50%, guess what? Your account doesn't drop at all. There's zero downside risk, 100% principal protection guaranteed. And that's why so many retirees love these. It literally removes the catastrophic risk.
And we've talked about these before on previous episodes, and we do understand that there's pros and cons to each annuity type. And with the fixed index annuity, we realize nothing is free. The trade-off is that there is a capped upside. So maybe you earn inflation beating returns in good years in the realm of 7 to 9%. But if the market rips higher, you're not capturing all of that return.
Yeah, that's right. And, I always try to describe an FIA like a seatbelt. You don't wear a seatbelt to drive faster. You wear it so if you crash, you actually have a good chance of surviving. And for the right person, that's exactly what they want, is that safety net.
Right, exactly. And we'll take a little bit of a look at the new kid, if you will, making some noise on the market. And I fielded many more phone calls about these coming in. We're starting to hear more clients be a little bit more well-informed about RILAs. And here's the pitch. So higher upside potential, caps might be in the range of 12 to 15%. And sometimes you can even get uncapped growth depending upon how it might be structured.
Yeah, RILAs are definitely gaining momentum. And, ultimately it's just about finding that right fit. But, unlike an FIA, in the RILA, you're going to accept some risk. And there is this magic word that's associated with RILAs, and that is called the buffer. So imagine essentially the market drops 15%. Well, if you have a properly structured RILA with, say, a 10% buffer, in that scenario, you only lose 5%. Or if it had a 20% buffer, guess what? You lose nothing. So the insurance company essentially is absorbing the impact there on the downside.
Right. And think of it like telling the insurance company, hey, listen, I'll take the first small hit if things go bad, but you protect me from a disaster. And in exchange, let me fly a bit higher when the markets are stronger.
Yeah, and I think that's really a fair trade-off. And that is essentially what people want as they approach retirement or start to enter retirement, is having some compromise, not giving up too much of the upside return potential, but they really want to be shielded from that downside risk or that potential disaster, if you will. So let's talk about the math battle here. So if you break this down with real world math, because this is really where it gets interesting. Why don't you fill us in there, Zach?
Yeah, so let's take one scenario of just being a bull market, right? So FIA with an 8% cap, as we see in many fixed index annuities, somewhere in the realm of 8 to 10%. But in FIA with an 8% cap, you make 8%, right? It's safe, it's respectable, but you just left 12% on the table if the S&P was up 20% on that year.
Exactly. So with the RILA, let's say that product has a 15% cap. In that example where the S&P was up 20% in that bull market, you'd make 15%, almost double what the FIA would have provided. So in strong markets, RILAs can dramatically outperform.
That's right. And why do we look at annuities to begin with? And that's for the protection. So in scenario number 2, we take a look at a correction where the market is down, let's say 10%. In an FIA, 0% loss, right? So principal is completely protected.
Well, let's look at the RILA. Let's say it has a 10% buffer. That's also equivalent to a 0% loss because that buffer is absorbing the entire drop.
Yeah, and here's the insight that some may miss in just understanding the differences between these two. In a mild correction, the RILA behaved exactly like the fixed index annuity did. And it actually had much higher upside and potential growth during those growing years.
Exactly. So let's talk now about scenario number 3, and that would be a crash, right? Where the market's down 30%. Now it gets real. The fixed indexed annuity, still 0% floor, sleeping like a baby. That's what we call it. That's the type of annuity it is. Sleep like a baby protection.
That's right. And with a RILA, let's say we have a 20% buffer. Remember, market crash, market's down 30%. RILA, we have a 20% buffer. The trade-off with this product is there's some areas of this downside that you're not protected in. And in this scenario, if market's down 30%, we have a 20% buffer, there's a 10% loss for you. Because the market dropped 30%, that buffer absorbed the first 20% of it.
That's right. So the question becomes is losing 10% painful? Well, for many, right? Many retirees, the answer is still absolutely. But is it better than losing 30%? Absolutely too, right? Everybody would agree that answer is yes. And the real question becomes, was the extra upside potential worth accepting that risk? And that's not necessarily just a product question. That's a personality question. In other words, it's really going to be dependent on the individual's tolerance for risk and if they can compromise on being willing to accept some loss with the potential to earn a higher upside gain.
Yeah, exactly right. And it becomes just a personality question, right? So at what position is somebody in? What suits them best? So who should buy what? So in profile A, the sleep at night investor, or sleep like a baby, if you will, if seeing a negative number on your statement makes your blood pressure rise, well, simple answer, stay with that FIA, their fixed index annuity. We have peace of mind as a value. So don't change returns if you can't, or excuse me, don't chase returns if you can't emotionally tolerate that downside.
This is especially true for retirees already drawing income. Stability matters more than squeezing out extra performance. So if we look at the next personality type, which we will call the inflation fighter, let's flip it. So if you're 55, maybe 60, and you realize you could live to 95, inflation becomes your biggest enemy. And ultimately, to overcome inflation, you need some growth.
Yeah, and this is where the RILA may shine, right? So you're intentionally trading perfect safety for managed risk because your future purchasing power matters more than the absolute protection would.
Yeah, and I think really the right way to look at it, right, is to create a combination approach. I don't think there's one product that does everything well. And that also applies to the annuity space. But they are tools, and they are tools to optimize certain areas of your overall plan. What I think makes the most sense to me, just as a planner and someone that works within this space and looks at all these products and hears different viewpoints from thousands of people over my career, it really comes down to like, how can you create an optimization but utilize multiple products to accomplish that? And really, I love the idea of like a guaranteed income annuity. It's probably an indexed annuity with an income rider. Give yourself really that stability of a pension like income stream combined with your social security, having that cover a majority of your essential living expenses, and then positioning a RILA as a 60/40, general historical portfolio composition, but use that RILA as that alternative, because that RILA is going to perform like a 60/40 portfolio, 60 equities, 40% bonds, but not be exposed to the same amount of risk that a 60/40 would. So if you could get strategic and use that income annuity to give that stability and that foundation of lifetime income, use the RILA for a safer growth option. It allows you then to have that safety net still and leveraging the buffer, but you're not giving a lot of upside away to get that protection. And then you can have a portion in the market still, in equities. And I think that that's like a really good blend of three different, asset classes, if you will, that can accomplish a big time optimization in the right areas to give someone more peace of mind. But let's not forget about the tax angle here. So, here's something both products also share, and it's huge, is that tax deferred growth. So you don't pay taxes every year on these gains in either product. Annuities always will grow tax deferred. And for high earners on people repositioning taxable money, that can significantly improve net outcomes over time.
Yeah, and I think the example you gave speaks exactly to the tax equation, right? So giving yourself that guarantee of income, knowing exactly what will be taxable from that income source. Beyond that, if we have that RILA or fixed index annuity, now we can position that as the inflationary tool or the as needed basis. So that if we do have to peel something away from it, then you can do that and know what to expect, as opposed to forcing yourself into this higher income range and new tax bracket that you may have not wanted to introduce to your plan.
Exactly. And it comes down to just understanding the appropriate application. Nobody should ever put all their money right in one basket. That includes an income annuity, that includes FIAs for growth, that includes RILAs with buffers and all of that. It really comes down to really trying to optimize the approach for better outcomes and more stability over time. And that's really the right application to address this equation, right? Is like, how do you come up or decipher which products to use and how much to put into any given one or combination.
Yeah.
It really comes down to understanding them. And what I can tell you is that whether it be FIAs or RILAs, it's going to come down to your personal preferences, what you can have an appetite for, what are your goals and objectives, and so helping you understand the appropriate way to leverage the different types and how to put yourself in the driver's seat. Ultimately, I think that's what many people want in retirement, is the ability to have some independency, right, from the general markets. There's things that we can't control whatsoever. A lot of the things in the markets we can't control at all. The only thing we can control is what we tell our money to do. And that's where it comes down to working with the right financial professionals, the right experts that can help you understand what products are available, what they're really good for, and how to appropriately apply them to your situation. And when you do tell your money what to do, there's a lot of confidence and clarity that comes from that. But if you just leave everything at chance, that would be just somebody letting it ride in the markets, even though you don't necessarily have the tolerance for risk that's required. That's where things get messy, bad or poor decisions are made, and discipline is lacking because you don't have the wherewithal to get through those bad times in the market. Where if you use income annuities or RILAs in this sense, it gives you a lot of control, a lot of clarity that you know exactly what's going to happen, and it gives you that tolerance to look at your assets overall with a different lens. And I think that's what many people want, is just the ability to still gain fair upside potential, but shield their assets, or at least a portion of them, from a big devastating loss.
Yeah. Yeah, without a doubt. And as Jeremiah mentioned, none of these are not all created equal, right? So working with a professional is going to be the biggest factor in this. Not all fixed index annuities are the same. Not all registered index linked annuities are the same. Some have buffers that are higher than others. Some have caps that are higher than others. And some are uncapped, right? So the math does change dramatically depending upon the carrier, the product design, and what's important to you yourself and what fits your personality.
Exactly. So the real message here is explore, research, but don't guess. Work with someone that can help you with that. That's something that we pride ourselves in. We use the right tools to help us ascertain the marketplace, help us understand what's important to you, and ultimately put you in the driver's seat to make more informed and educated decisions. And if that's something that you're looking for, you want to go down this path of comparison, or really looking at strategic planning, using annuities for income and or protected growth, we would love the opportunity to earn your business. And you can do that by finding, in the description of this video, wherever you may be watching, there will be a unique link to schedule a time to meet with either myself or Zach or someone else on our team. And we'll go through that exploratory discussion with you, understand what matters most to you, what your concerns may be, what outcomes you wish, and then we'll walk through, hold your hand, give you that white glove experience of really knowing exactly what products to consider and how to ultimately make a more informed decision. There will be a unique link to do that, or if maybe you're not quite ready yet and you just want to start with requesting a free annuity report, we provide the most transparent report in the industry. It'll give you things like rates, fees, carrier ratings, the whole nine, to make a more informed decision. You can also request a free report in the show notes here by clicking on that unique link. But with that being said, never, ever will you ever experience a high pressure sales pitch process. That's not how we operate. We're here to really give you the transparency, the education, and ultimately access to the entire independent annuity marketplace to give you the ability to make a more informed decision. And that's something that we pride ourselves in. So if you did find this episode to be helpful, you can please share this with friends or family that may benefit from it as well. It helps us get our viewership up. If you like what you heard, give us a thumbs up or subscribe to our channel. That would be greatly appreciated. Through these mediums, it helps us achieve our mission of creating a better annuity buying experience and putting people in the driver's seat to make a more informed or empowered decision on their retirement future. Zach, did you want to close us out?
Man, that is it, brother. We didn't even start it, but that's going to be it for us. The annuity
dudes. And remember, we're here for you to make a better decision. Let's do it. Let's do it together. That being said, we're signing off. Annuity Dudes out.
See you.